NIO just delivered one of the strongest sales months in its entire history, and Wall Street punished it anyway. Sales up more than 60%, a brand new company record, and the stock still slid nearly 10% in a matter of weeks. If that sounds backwards, stick around, because in the next few minutes, I'm going to show you exactly why NIO stock plunged after record sales, and why that plunge might actually be the biggest head fake of the entire summer. Welcome back to Smart Stock Sam, the channel where we cut through market noise and turn confusing, contradictory price action into a clear, actionable trading plan. Today, we're breaking down record-breaking delivery numbers, a hidden guidance miss that triggered a violent algorithmic sell-off, quiet institutional buying happening behind the scenes while retail traders panic, and an options map that's already telling us where this stock wants to go next. By the time this video ends, you'll have a complete, actionable blueprint for trading NIO through the week ahead, plus the 4 metrics every long-term investor needs to track for the rest of 2026. Could this whole sell-off simply be noise dressed up as a crisis? Let's find out together, starting right now. Let's start with the number that should have sent this stock soaring straight through the roof. In June of 2026, NIO delivered 40,597 vehicles. That's growth of 62.9% compared to the same month last year, and it's the strongest single month the company has ever posted. They are moving metal at a record pace, factories humming, showrooms busy, delivery centers stacked. Now look at what the price did instead of celebrating any of that. Shares gapped down from a prior close of $4.97, sliding to $4.79 in a single session. That's a textbook valuation disconnect, where the stock trends aggressively lower while the actual underlying business is accelerating in the opposite direction. On the surface, it makes almost no sense at all. So what is actually driving this reaction, if the growth story is this strong? There's one hidden number buried inside the quarterly report that explains this entire move, and we're getting to it right now. Here's the exact moment the algorithms took control of this stock. For the second quarter, NIO delivered a total of 107,658 units, a massive 49.4% year-over-year jump. Almost any company on earth would proudly celebrate growth like that. But here's the twist. Management had already guided the market to expect somewhere between 110,000 and 115,000 units for the quarter. NIO landed just below the bottom edge of that range, missing by roughly 2%. In today's automated, algorithm-driven market, that tiny miss mattered more than the huge growth number sitting right next to it on the same page. The machines don't read nuance, they read thresholds. And a 2% miss was more than enough to trigger a wave of automatic, emotionless selling within seconds. But is this really the full-blown disaster the falling chart is suggesting to everyone watching? Could this genuinely be the start of a permanent unraveling? The probability of that says otherwise, and here's exactly why. Let's separate the real threats from the noise, because right now there's a lot of both floating around at once. On the headwind side, there's genuine geopolitical pressure weighing on sentiment. The Pentagon recently added several Chinese companies, including NIO, to a restricted list, a move NIO has firmly and publicly pushed back against, but fear tends to travel far faster than facts ever do. There's also softer demand for the ES8 SUV, which dipped below 10,000 units in June after a 10,000 yuan subsidy phased out completely. Now here's what the market seems to be completely ignoring in all this panic. NIO's battery asset arm, Miratori, just raised more than 2 billion yuan through green asset-backed securities at a record low rate of 1.68%. That's essentially free capital in this environment, and lenders don't hand out rates that low to companies they think are in trouble. On top of that, original software chief Qian Wang has returned to lead in-house vehicle software development, a move insiders see as a serious vote of confidence. These are real, structural wins quietly hiding behind a wall of short-term fear and headline noise. So why did ES8 demand really fall off a cliff so suddenly? This is a classic case of a company's own newer product quietly cannibalizing its older one, sometimes called the Osborne effect. Buyers aren't disappearing, they're simply waiting on purpose because a refreshed 5-seat version of the ES8 just launched into showrooms. It's not lost market share at all, it's delayed gratification from shoppers who already want the brand. Meanwhile, look at what's happening on the other side with the ES9. Market reception has been outstanding, hitting 10,000 deliveries within its very first 30 days on sale, an extremely fast start for a new model. The algorithms priced in the temporary ES8 friction instantly, but they completely overlooked the ES9's explosive early momentum sitting right beside it. Could that early spark fade completely in the coming months and leave this thesis empty-handed? It's technically possible, but based on current order trends and waitlists, that outcome looks highly unlikely right now. Now let's strip away unit counts entirely and look at pure profitability, because this is exactly where the real thesis gets strong. The whole electric vehicle sector has been dragged into a brutal, margin-destroying price war over the last year. NIO has largely refused to play that game, leaning instead on a premium sales mix rather than racing competitors to the bottom. As a result, vehicle margin sits at a healthy 18.8%. That's genuine structural strength, not a lucky quarter. Yes, net margin is still deeply negative at negative 8.78%, and I know that number alone looks alarming, but don't let it scare you without context. That gap comes from heavy, ongoing investment in research, development, and ecosystem expansion, including their fast-growing battery swap network across the country. At the unit level, NIO is already profitable on every car it rolls off the line. The real question left standing is whether that translates into an actual company-wide net profit soon, and a major Wall Street bank just leaked a forecast that could completely change this entire narrative. Right now, we're sitting squarely in the worst possible quadrant for sentiment. Short-term attention is locked entirely onto that 2% guidance miss and the temporary ES8 slowdown, and nothing else seems to matter to the tape today. But shift the lens toward operational reality for a moment, and you find nearly 50% year-over-year growth alongside structural health that beats most domestic competitors in the same segment. And here's that Wall Street forecast I promised you earlier. Deutsche Bank just projected that NIO will reach non-GAAP break-even in the second quarter, specifically a 5 million yuan net profit, driven largely by higher-margin ES9 sales rolling in. The market right now is pricing this stock like a failing startup on the verge of collapse. Deutsche Bank, meanwhile, is pricing it like a company about to cross the profitability line for the first time, which read, "Do you honestly think the price eventually catches up to?" If retail traders are panicking and hitting the sell button, what is the smart money actually doing right now behind closed doors? The average analyst price target currently sits at $6.70, implying serious upside from today's $4.79. That's a gap most traders would love to have on their side. We're also seeing real, tangible upgrades rolling in. HSBC moved to a buy rating with a $6.80 target, and Nomura upgraded to buy at $6.60. But ratings are cheap to hand out. Positioning is not. In the fourth quarter of 2025, Goldman Sachs increased its NIO stake by 57%, bringing its position to roughly 14.4 million shares. Yes, Leonteq Securities trimmed its own stake by about 57% in the first quarter of 2026, and I won't pretend that number doesn't exist. But when a firm the size of Goldman Sachs is aggressively adding to its position, that tells you where real confidence is actually building, even while the chart on your screen looks genuinely ugly. Let's turn to the charts now, because technically this stock looks like it's just been through a full-blown storm. Price sits at $4.79, well below both the 50-day moving average near $5.59 and the longer 200-day moving average as well. A textbook technician glancing at this chart would call it a strong sell signal without hesitation. But look a little closer at the oscillators sitting underneath the price. The 14-day Relative Strength Index sits at 35.45, edging right toward deeply oversold territory. The MACD momentum reading is also strongly negative, at negative 0.043. Picture the price like a rubber band that's been stretched hard toward the downside for weeks now. Momentum readings like these have historically preceded sharp, sudden, mean reversion bounces in this exact stock. Does that guarantee a bounce happens right on schedule this time? Of course it doesn't. Nothing in markets is guaranteed, but the current setup rhymes closely with previous turning points. Now let's check who's actually betting against this stock right now. Short interest currently sits above 134 million shares, giving a days-to-cover ratio of 5.79. Normally, elevated short interest like this gets traders excited about the possibility of a squeeze. I want to manage expectations here, though, because the full picture matters. The borrow fee to short NIO currently sits at a record low of 0.51%, which tells us shares are extremely easy to find right now, meaning a violent mechanical short squeeze is genuinely unlikely in the immediate term. Here's the far more interesting detail buried in the volume data. 41.49% of total trading volume is happening off-exchange in dark pools, away from the lit exchanges most retail traders watch. That kind of routing usually signals heavy institutional positioning happening quietly, well outside what retail traders can actually see on their screens day to day. This next data point might honestly be the single most useful piece of information for short-term traders watching this stock. Looking at the options chain for the July 10th expiry, the strike acting like a powerful magnet right now is $5 even. There's a genuine battleground forming right at that level, with more than 12,200 call contracts stacked against roughly 6,400 put contracts, all expiring together. Market makers tend to hedge their books in a way that naturally pins price close to a heavy strike like this one as expiry approaches. Below that, there's a clearly defined floor near $4.50, backed by 1,549 put contracts standing guard, and a strong ceiling at $5.50, guarded by more than 23,000 call contracts overhead. The lines for this week's battle are already firmly drawn on the board. Put all of this together, and you get what I like to call the convergent setup. And it's genuinely rare to see all three pillars line up this cleanly at the same time. Technically, we have an RSI below 36 after a roughly 10% year-to-date decline in the share price. Fundamentally, we have robust 18.8% margins, record June output, and a major bank now forecasting a 5 million yuan profit for the quarter ahead. And on the derivatives side, we have a solid put floor near $4.50 and a heavy magnet pulling price toward $5 flat. Where all three of these circles overlap is a genuinely asymmetric risk-to-reward zone, sitting between $4.60 and $4.70, and that's exactly where our attention belongs this week. So how do we actually trade this over the next 5 trading sessions? Here's the complete blueprint for the week of July 6th through July 10th. The bias here is long. We're playing for a mean reversion bounce off oversold conditions. The optimal entry zone sits right where price is currently consolidating above institutional support, between $4.60 and $4.75. Our first target is $5 flat, the immediate options magnet we just walked through together. If buyers push through that level with real conviction behind them, it could trigger a gamma-driven hedging squeeze, where market makers are forced to buy shares themselves to cover the calls they've already sold, potentially pushing price toward a second target between $5.20 and $5.50, right where the 20-day moving average and that large call wall line up perfectly. None of this matters at all without a clear plan for when you're wrong, so let's talk risk management properly. Professional trading is roughly 10% entry and 90% risk management, and that ratio never really changes. Primary support sits between $4.40 and $4.50, reinforced by that heavy put-open interest we mentioned earlier in the video. But if that shield ever truly breaks, you don't want to be the last person still holding shares. Your hard invalidation level, your firm stop, is a daily close below $4.44, which marks the recent long-term correction low on this chart. If NIO closes a session below that line, the bullish setup is completely off the table, no exceptions, no hoping it magically comes back on its own. Now, if you're here for more than just a 5-day trade, these are the 4 bigger metrics to track through the rest of 2026. First, margin stabilization. Watch closely for vehicle gross margins to hold steady in that 17 to 18% guidance range management has laid out. Second, sub-brand volume. NIO is scaling its Envo brand, targeting 55% of group sales, and its Firefly brand, targeting 10%, so early pre-order numbers for the Envo L80 will matter a great deal here. Third, supply chain costs, as NIO shifts away from NVIDIA hardware toward its own self-developed 5-nanometer autonomous driving chips, which should meaningfully cut input costs going forward and improve margins further. And finally, ecosystem expansion, highlighted by NIO Capital's recent $15 million investment into UXIN, strengthening their used EV and trade-in network across the country. Short term, the chart in front of you looks messy and chaotic. Long term, the underlying foundation is quietly getting stronger with every passing quarter. Could all 4 of these trends somehow reverse at once and completely sink this thesis overnight? Statistically speaking, that's a real stretch, but it's exactly what we'll keep watching for together going forward. Before we wrap up, a quick but important disclaimer. This video is for educational and informational purposes only and should not be taken as financial advice of any kind. I'm not a licensed financial advisor, and every price level, target, and scenario discussed here is based purely on publicly available data and my own personal analysis of that data. Markets are unpredictable. Stocks can and do move against even the strongest-looking setups, and past performance or historical patterns never guarantee future results. You should always do your own independent research and consult a licensed professional before making any investment decisions. Never invest or risk money you genuinely can't afford to lose. Now, let's wrap this whole thing up. NIO just posted its strongest delivery numbers in company history, the stock sold off anyway on a narrow guidance miss, and underneath all that noise, institutions are quietly building positions while the options market maps out a clear, defined path toward $5 and beyond. That's exactly the kind of disconnect between price and reality that creates real opportunity for traders who know how to read it properly. I want to hear from you directly on this one. Do you think the market is genuinely overreacting to this 2% guidance miss, or is there a deeper, more serious problem with NIO's growth story that the charts simply haven't priced in yet? Drop your honest answer down in the comments below. I read every single one that comes in, and I reply as often as I possibly can. If this breakdown helped you see NIO a little differently, do me a favor and hit that like button. It genuinely helps this channel reach more traders who need this kind of analysis. And if you haven't already, subscribe to Smart Stock Sam so you never miss a trade setup like this one again. If you want to go even further than that, I've launched a channel membership built specifically for serious traders and investors who want an edge. Members get early access to trade setups before they ever go public on this channel, priority replies to your questions, and custom analysis on any stocks you personally request from me. If you're genuinely serious about leveling up your investing or trading this year, that community is exactly where you want to be. So check the join button right below this video and come grow with us. And if this video specifically helped you out today, you can also send a super thanks right here on YouTube using the button below the video. It's a small but meaningful way to directly support the research, data, and hours of work that go into videos like this one. And I genuinely appreciate every single one of you who chooses to do that. Thanks for watching, trade safe, manage your risk, and I'll see you in the next one.